Well, a very good evening for those in the waiting room and who are joining on the latest RAN Swiss webinar with me, Anthony Clark of Small Talk Daily. I'm sitting here in the sunset in Cape Town. We've had a lovely day, although the wind is picking up. Any of you that live in Cape Town will know we've had an awful winter, but hopefully summer is on its way. If I look like I'm a bit tired, it's amazing what good lighting and a crisp shirt does for one. I woke up this morning at 2:45 a.m. to listen to the JD Vance and Tim Walz Vice President update on CBS News in the States, hoping there'd be the same sort of fireworks we got from the Donald Trump, Kamala Harris debate a few weeks ago, but there wasn't any. The two gentlemen were very amicable. They agreed with each other, and quite frankly, it was very boring. So apart from me waking up the dog, who's sleeping right behind me here behind my chair, it wasn't much to wake up for. But I'm a big follower of politics because, as we all know, politics and geopolitics, quite frankly, makes the world go round. And as I was saying to Pascal before we came online, given what's been going on overnight with Iran firing 180 missiles at Israel and the expected rally in the oil price, and now the concern about what the retaliation will be for Israel against Iran, the world is sitting back on tenterhooks. And as we all know, there's nothing worse for capital markets and for global stock markets than uncertainty, particularly in what is a powder keg of the Middle East currently. And with the US election ahead, literally in 35 days, we have a very, very interesting dynamic currently going on globally. But we're not focusing on what's going on globally. We're focusing on what's going on domestically. You all know I cover the small to mid-cap market very exclusively. I have done for many, many years. Luckily, I'm keeping my head looking straight on, so I can't see the grey that's growing rapidly behind my ear. But the market year to date has done exceptionally well. But as I said to Pascal, if you'd been in the JSE Aussie market, the small cap market or the mid cap market from the beginning of 2024, you actually wouldn't have made much money. The entire indices changed on June the 10th. And I've been doing quite a few presentations for the last few weeks. And as I track the market very closely, particularly in my universe, it was quite noticeable from my perspective, given the results coming out, and more importantly, the annual general meeting feedbacks, which I'll get to shortly, why the stocks started moving when they did. Yes, the national election was over. Yes, there was certainty that the government of national unity was going to be formed, and that led to a strengthening of the rand, a bit of a feel-good factor. We were also going into the interest rate cutting cycle. So a number of stars aligned, which led to the market rallying. But certain indicators were already there, and I'll try and touch on those as we move through this presentation. As I said to Pascal, I'm not going to spend too much time rattling on about my top 9 stocks. I'll give a very brief rundown as to what's been going on in the last quarter, but I will be hopefully doing a fair bit of Q&A sessions in the end. So if I can get my chat box to actually work, because I'm still technologically disadvantaged here in my intellectual capability, I will do a fair bit of Q&A towards the end, because I'm sure that's where many people will have questions. But just a touch point here, the JSE All Share, as it stands right now today, I updated my price matrices before I came online, is year to date up 16.95%. If you'd bought on June the 10th, you'd be up 14.34%, showing you how much of the gain has actually come literally in the last 3 months. On the mid-cap index year-to-date, you'd be up 18.23%. But if you'd actually bought on June the 10th, you'd be up 19.22%. The mid-cap market was negative up until June the 10th. And the astonishing one is the small-cap index. That's started the year extremely well. It was up year-to-date 23.55%. But again, if you'd bought on June the 10th, you'd be up 20%, showing you that in many cases, timing is everything. So I'm going to run through very briefly the top 9. Just as a reminder, they are Afrimat, Argent Industrial, Astral Foods, Curro Holding, KAL Group, the former Kaap Agri, Libstar, Novus Holdings, Premier Group, and Reunert. The aggregate basket up until the close of business today is up 43.54%, which is a significant win versus the varying benchmarks that I track, which is the mid-cap index, which in my portfolio is up 18.23%, and the small cap is up 23.55%, showing you that these 9 have performed exceptionally well year to date, and they were actually up quite nicely, not just from June the 10th, they actually accelerated from June. They were up quite nicely from the start of this year. And as I've said in varying other presentations to you since the start of this year, I chose that basket for a reason. They were all fairly large mid-cap stocks with a certain degree of quality and balance sheet quality. They had what I call defensible moats. So regardless of which way the election would go at the end of May, I believe that the stocks, if the election went badly or if it went well, would have a very strong underlying support mechanism in terms of earnings and the share price appreciation which I anticipated. My small cap stocks were Argent Industrial, and then my wild card was Libstar. I'm sipping my juice here. I'll need it because I'm getting over a bit of a fever last week and my voice is a bit hoarse. I'll just jump right in. The top performing stock as it stands at close of business today is Argent Industrial. Including dividend, it is up 82.95% year to date, which is a staggering performance. Argent Industrial today hit a new 52-week high and a record lifetime high. I've covered the stock for over 20 years. And interestingly, despite the near 82% rally we've seen in the stock year to date, on my forecast for earnings to March 2025, which is not that far away, the stock, despite the price being 27.30 Rand, is trading on a forward price earnings ratio of 5.3 times, which is hardly demanding for a company which has given you an unbroken earnings track record since 2019. Now, the company is a September interim period. They reported earnings this time last year of 2.23 Rand in round numbers, which were up 23%. I'm not anticipating such a great number this year. There's a couple of factors have gone against not the company, but the underlying sector it plays in. One, in the UK, the Chancellor put up a tax rate in the last 12 months from 19% to 25%. And of course, the strength of the Rand following the Government of National Unity means that the crosses between the Rand dollar, the Rand euro, and the Rand pound have slightly firmed, which means there's been a slight shift in the translation benefits. But I'm still anticipating Argent Industrial to show good gains, probably in the mid-teens. So I'm utterly unconcerned that the recent share price run has gone ahead of itself. The really interesting thing which I track, and I think some of the others listening may track too, is when a stock starts rising in exceptionally good average daily trade, or even above average daily trade, I actually have a certain air of confidence that there's an underlying push in the stock that is not being driven by speculation or what I call the Johnny-come-latelys coming into the stock because they've seen it performing. Because quite frankly, when I see a stock like today trading up to 240% above its average daily trade, and it's been consistently good trade, it means there's solid demand behind the company. And as I said, on a forward rating of 5.3, despite the stock being up 82%, it still has legs. Every single price target I've set for this company since 2019 has been made and exceeded. My last price target was basically shattered. So I'm now waiting for a chit-chat with the company in the coming days, and I will reset a target. I would imagine it's probably going to be into the 30s. I still believe in due course the company will list its stock on the London A market. And even if they get an average rating for the London A market of around a 7 or an 8 times, it potentially gives a target value for this company in theory, and I'm talking in theory, of nearer to 40 Rand. So I still see good upside in Argent Industrial. The second best performing stock is Novus Holdings, the legacy printing, packaging, and education learning business. Year to date, including dividends, it is up 81.82%, trading at 7 Rand to close the day. And again, it's literally at its 52-week high. It's not back at its all-time high. For those that actually remember when Pal Media was basically listed and it changed its name, it listed at about 15 Rand 50, probably about 15 years ago, and it was a complete unmitigated disaster. The legacy printing business was an old dog and a dinosaur, and nobody wanted to touch an analog printing business because everybody wanted to be in digital and latterly AI. And the share price at one point back in 2021, before the activists got involved, fell to over around 64 cents. And at that point, the underlying cash balance held inside Novus in terms of cold, hard, dirty cash was greater than the underlying market capitalization of a company, which is why A2 Investment Partners came in, bought a substantial stake, but now owns 65% of this company. And if you'd bought that stock on my initial recommendation in April 2021 until today, you'd have had a very healthy return. You've had a share price moving from 1 Rand 40 to 7 Rand, and you would have collected 1 Rand 90 in dividends. So despite the fact the stock is knocking on a 52-week high, and I have a target price of 7 Rand 50, I'm slightly more cautious of the company in the near term. Not because I'm turning negative on the company, but the company had 2 price targets, which I had this year. They've both nearly been made. One was 6 Rand and the other was 7.50. We've got results coming up to September, and I need to indicate that whilst I expect a very healthy trading update, given the base that Novus had last year of around 28 cents, and they earned roughly 78 cents for the full year, the company is spending aggressively on its education learning division, and particularly on its Maskey AI app, which is an educational learning tool which hopefully will galvanize the educational system in this country to keep supporting the Maskey Miller learning products that Novus undertakes. But that's a capital spend of several hundred million Rand may not see a return for quite some time. So despite Novus having a fat cash balance as of a last reported detail of 871 million Rand, and it is very cash generative, there may be a bit of a slightly lower or softer growth number purely because of the investment being made in underlying businesses. Not to say that I'm not expecting good growth from a company. I was at the AGM a short while ago, and Andre van der Veen, the CEO, indicated that given the very healthy cash generation of Novus, and they have 3 silos in printing, packaging, and education learning, they would absolutely look for bolt-on acquisitions, even potentially in non-complementary areas of industry to bulk up the company. And I continue to believe that this company, whose market value is now about 2.5 billion Rand, and who's now on the radar of many of my institutional clients, it wasn't before because it was too small, could end up becoming a very interesting investment holding company. And for those that follow the underlying machinations of the activists concerned, which is A2 Investment Partners, they have stakes in Nampak, which, as we all know, has done fantastically well year to date and since the start of 2023. They also own York Timbers, and of course they own Novus. And all of those assets have done very nicely for the activists and for the shareholders that have participated in those assets. So anything that Novus is potentially looking at, if it is disclosed to be a listed entity, should certainly be something that the market should keep an eye on. The third best performing stock in my list is actually Premier Holdings, the milling, baking, and grocery company, which year to date, including dividends, is up 71.29%. It was the #1 stock in my portfolio as of a week ago, when the company basically went into the Aussie 100 index. On the 4th of September, I was the lone participant in the annual general meeting. And as I keep saying to anyone that wants to listen to me, which I don't think there are many these days, I rate AGMs as possibly the most interesting event that I participate in any corporate meeting at any point in the year. You have the board generally to yourself. They're very happy to ask questions. And as it's a public forum, the answer they give you, quite frankly, is very valuable. And that meeting, they indicated to me on the 4th of September, in a note that I wrote to my institutional clients on that day at 78 Rand, clearly indicates that the interim results to the end of September were going to be absolutely stellar. They were up 37% of the full year number, and they were up about 26% of a comparable F-year half one 2023. All the underlying metrics that support Premier, which is lower diesel price, because their ovens are heated either with electricity or with fuel. They deliver to 70,000 drops a day with their trucks. So with the fuel price year on year, like on like, down 26% in diesel, but all starts to add up. The wheat price is also down sharply from its high this year of 6,850 Rand. It is currently trading, as I checked earlier, at about 5,994, which is basically flat on the year, but down from its high. And of course, they've managed to push through price increases. And the underlying product that they sell, which is bread, mealie meal, and basic groceries, continues to be in very strong demand. But the really interesting thing that grabbed me was they indicated that the stock was being included in the Aussie 100 index. Now, it's not a very well-followed index. There isn't a huge amount of money tracking that segment. But given that Premier at that time was trading at about 78 Rand, and there was very tight liquidity because the bulk of the stock is either owned by Brait or by Christo Visa and very large institutions like Allen Gray. Any inclusion in a new index was bound to bring players into the market to get stock to be part of the index. And in the dying days before the index was consummated with Premier going in, the share price ran from 78 Rand to 119. You would have made extremely good money. So when I went out with the buy at 78 Rand on the 4th of September with a target price of 90 Rand, which was an upgrade because my previous target of 72 had been made, I didn't believe the stock would get to my target price and exceed it in 2 weeks. We're now back to 104. I did bring back the company to a hold on the 26th of September, but it's a stock that I continue to favor. It possibly has one of the best management teams in the sector. And I wrote a note this afternoon to my institutional clients, once again indicating that many of the metrics that play favor to Premier and the entire food producer sector, which is lower maize costs going into 2025 on an expectation of an improved harvest. And as such, the SAFEX market is trending significantly lower year on year. With the current yellow maize, with the current white maize price priced at 5,500 tonne, we're looking at about 3,900 to May, June next year, which is a significant fall. The diesel price is down. We have no load shedding. And the likes of Premier have had the benefits of margin expansion through price increases. So I expect Premier to continue to have a very, very good period. But with a share price trading at 104 Rand, above my 90 Rand target, I have to be a bit cautious because there's a lot of froth in the marketplace. And some of you may have picked up in the last 24 hours that Brait did place 1.69% of its stake in Premier to raise a bit of cash. And that did add liquidity into the Aussie 100 rally. So I think the market may be a little bit full in the short term, and I wouldn't be chasing the stock. And then my third best performing stock looking on the list here is Reunert, including dividend that is up 38.6% year to date. I chose that stock for a combination of reasons at the beginning of this year. At that point in time, it was an 11 billion Rand company. It was the biggest mid-cap in my selection of the top 9. Exceptionally good management under Alan Dixon and involved in all of the areas of the industries and the economy, which I thought would benefit depending on which way the economy went. And of course, on geopolitics. They have a very strong defense arm with a very large international defense element in communications, particularly in the Middle East, which is currently the flavor of the month regarding geopolitics. They have a very interesting cabling division, and we all know that Eskom needs to upgrade its electricity reticulation, not just on a national network basis regarding the overhead power lines, where 14,000 kilometers have to be installed to meet the underlying demand and the upgrade to the system, but of course on a municipal basis. Now, we all know that municipalities in this country, quite frankly, have been run into the ground, predominantly by the dysfunctional ANC governments. And many of those governments, or many of those municipalities have seen their local reticulations basically fall over. So there's no point in having a stable ESCOM if the power gets to the municipalities and the substations and the transformers basically go bam. So I would anticipate that there must be a significant amount of activity that will happen in the coming years in infrastructure in that segment. And then lastly, Reunert has a very interesting ICT business, which is an amalgamation of a recent transaction, which should gain efficiencies. So a combination of defense, infrastructure, green and renewable energy, and ICT, I thought would position Reunert extremely well. And let's not forget, as a quality blue chip mid cap, if the market were to be predisposed to foreigners coming into the JSE and mopping up some interesting stocks, and I don't believe they're in to any great degree. They tend to go for the larger liquid blue chip mid caps, which have a scale, a market value which is generally over $500 million, and where they actually have a great track record. And Reunert is one of those stocks, and it's performed extremely well year to date. Another stock which has performed extremely well has been Libstar. Year to date, the stock is up 30.3%, including dividends. But I have to caution, the stock is trading currently at R4.15. When I chose the stock at the beginning of 2024 at R3, at R3.30, my apologies, I set a price target of R4.50. That R4.50 price target was made a couple of months ago. So I made my gain. It was up over 40%. It had a very interesting, market-pleasing 5-month trading update. But when results hit the market in early September, in the feedback from Charles de Villiers, the CEO, it became very clear to market analysts who follow the company. And I was lucky enough, as always, to have one of the first one-on-ones with management after the results presentation. And the narrative that I got ahead of the crowd was that they have no real clear line of sight to the second half of the calendar year. Libstar tends to be very seasonal, as most food companies actually are. The first half is normally between 40 and 45% earnings, and the second half between 55 and 60%. And as of the early part of September, they had no visualization as to which way the second half of the year would go. That engendered an area of caution into the marketplace, and that has seen the share price drift slightly lower. It's been bouncing around R4, and it's been trending for the last week or so at around 410 to 420. We should get a 10-month update in October, and I would wait until that update to see which way the second half is going to go. In the full year last year, they made 58 cents, and in the first half, they made 20.5, up 11.4%. Now, there's a number of very interesting businesses inside Libstar, including an export business in herbs and spices, and of course, very large businesses that supply Checkers and Woolworths, particularly with ready meals and upmarket products that pretty much many of the listeners to Rand Swiss will know. There's a very large contract, for example, for chicken schnitzels inside Woolworths, which is an extremely large SKU. In fact, one of the top 3 selling products inside Woolworths. And if you walk down any grocery aisle inside Woolworths, which I've done with clients, roughly 30% of any dry grocery aisle is products supplied by varying elements of Libstar, either on the bakery side, the dry grocery side, condiment side, sauces, etc., etc. So it's a very important business to many large quality retailers. So it's a symbiotic relationship. But as I said, given there's a certain air of uncertainty regarding the second half, I'm slightly cautious. But I have to say that the target was made, as now at 415, and if the second half does provide some confidence regarding the year into December, I think the share price will start knocking on the door of 450. As it stands right now, I have to be slightly cautious, and I'm holding my powder dry. Now, running through some of the other stocks, which I think would interest many. Afrimat, I know, is a very, very well-followed stock amongst listeners to this webinar and the wider private client market base. Year to date, the stock is up 13.91%, including the dividend. It has been substantially higher. It got to about 76 Rand at its high. And I started writing from July the 12th, July the 18th, August the 8th, the end of August and early September, that I expected a period of weakness to come ahead in Afrimat's earnings, particularly for its interim results to the end of August 2024. Now, the company in half one 2023 earned R2.63, and for the full year to February 2024, they earned R5.67. 68% of Afrimat's profit is derived from iron ore. Now, anybody that follows the iron ore market, and I follow it extremely closely, will have seen that the problems in China and the flatlining of that economy has basically seen the underlying demand for iron ore actually wane quite substantially year to date. It reached a low point literally about a couple of weeks ago at $90. It started the year at $144. I also track the rand dollar and the rand price per dollar of iron ore. And from its peak, it is now down, looking at my numbers here, 785 rand a ton. Iron ore presently is trading at $108.74. It has rallied quite sharply in the last week because anybody that follows what's been going on is that the Chinese government, under their central planning regime, has come out and sharply stimulated the underlying monetary system in China by freeing up capital from the banks and stimulating the housing market to try and kickstart a very weak and stagnant economy and to try and bolster what is a very deflationary environment. That has seen the stock markets boom, as I'm sure we've all seen with the likes of an Alibaba, a JD Group, etc., etc. That has had a resultant kick in the iron ore price, up from around $92 to about $108. But interestingly, the proof is only the pudding. Just because the Chinese government has suddenly freed the taps up in underlying loosening of the fiscus, there are other elements in play regarding the Chinese steel market, which the market needs to be aware of. I'm certainly no iron ore expert, but I do track all the underlying levers apart from the iron ore price. One is the fact that the Chinese government has a cap on the annual production of steel. I mean, it hasn't changed in the last 2 or 3 years. So unless they change that cap, the market is fairly fixed in terms of its output. Secondly, because of the underlying margin pressure in the Chinese steel economy, many of the large Chinese steel companies are making no money. And as such, the rising iron ore price doesn't exactly aid their situation. If their product in terms of output is capped, their costs are rising and they can't expand their margins. And then lastly, there's the environmental element. The Chinese government, due to significant criticism by the West, is trying to green up its economy and reduce, the pollution that comes from many of its dirty industries, of which iron ore is one. And they are very, very tight on environmental emissions. And they have in the past, including fairly recently, closed the steel sector in certain regions for extended periods of time because of the emissions, particularly in the summer region, as the smog that goes into Shanghai and Beijing has been quite prevalent. We saw during the last Olympics how bad the smog can be. So in Afrimat's case, I have written and I've gone on public record that I expect, and I will say this to a wider audience, but I expect a classic JSE profit warning to come out from Afrimat in its trading update for these 6 months to August. I would anticipate the earnings will probably be down between 20 and 30% of the R2.63 they earned. And depending on the quantum of that trading update, if I am correct, depending on how well the second half does, and again, that's fairly predetermined by the iron ore price and a pickup in the cessation of losses from Lafarge and cement, it could have a significant impact then to their FY25 results to February. If they have a terrible first half, it is very difficult for a company to try and catch up in the second half if they have a terrible first half. So despite the fact that Afrimat is holding quite steady currently at 67.90, it is my current belief that the market or elements of the market are just looking at a short-term bounce. Excuse me. But certain elements of the market are looking for a short-term bounce in iron ore, particularly in the last week and a half, and saying, oh, well, Afrimat's going to do better. But if you follow the market as I do, and particularly the pricing mechanism and the structure that Afrimat has in place with Kumba, that does all the marketing and sales, there's a 3-month lag to when Afrimat actually gets its money from Kumba. And there's a very interesting price formula in place. And not all of its product is actually exported. Only about less than a half of its iron ore product is exported. The balance goes to ArcelorMittal, the local steel company, and where Afrimat sells its iron ore at a significant discount to the spot market. I have disclosed in the past what that discount is. It is probably less than 40% of the current spot market. So they need volume to actually make up a difference. And unless ArcelorMittal does well, Afrimat doesn't do well. And of course, we also have the infrastructure issues with Transnet. So I would be very cautious with Afrimat in the coming week or so. The trading update should be out literally in the next week or two. And as I've written, I would be very, very cautious in trying to push Afrimat higher if indeed I believe the trading update is going to be particularly weak. I can see the share price back to between 60 and 62 if my crystal ball comes right, but we'll see. Only time will tell. I'll either be sitting here in a few months saying, well, there we are, I told you so, or I'll be sitting here saying I got it completely wrong and I'll change my tune. But I think that the current dynamic means that the interim results to Afrimat will not be that great. Quickly running through some of the other stocks. KAL Group, or the former Kaap Agri, also year to date is up, I have to look at this, it's now up 29.6%, including dividends. Again, a strong performer from a retailer which is still on a P of around 8. As we all know, there's still this market misconception that KAL Group is an agricultural business, but only 29% of a company's trading profit in the last period was generated from agriculture. The balance comes from a combination of retail, fuel stations, convenience stores, and quick service restaurants, where they have a very wide nationwide footprint. But as I wrote in a note, which went out to my institutional clients, literally, I think on the 25th or 26th of September, I warned my clients that I now foresee flat to perhaps negative earnings coming out from KAL Group for its year ended September 2024. Despite the fact that the first half was up about 7%, the second half, particularly in quarter four, saw a substantial fall off in demand in the retail sector, particularly the fuel side. And because of a cold, wet winter, the agricultural side saw a bit of a slump in underlying spending by the farmers. We also had some problems on the fuel side where certain KAL operations were impacted by Sandroll roadworks. And given the lack of coal being transported from the coal belts down to Richards Bay, there's been a substantial decline in the volume of truckage in certain routes. And the underlying flow through of foot traffic into the QSR and the convenience stores has also been limited, because with load shedding having now ended 6 months, touch wood, the days of consumers leaving work and popping into the nearest fuel station, where we all knew they had electricity or generators running to buy ready meals or takeaways or food, has basically waned, because we can now cook and eat at home to either save money or just because it's more convenient. And it's also had a knock-on effect. So from the R6.18 that Kaap Agri earned to September 2023, at best, I expect this year the company will be flat, and at worst, it could be down a few percentage points. Now, it's certainly not a train smash. There is nothing fundamentally wrong with the strategic proposal and the strategic intent of management or the company. It's just a bit of an economic speed wobble, which we've seen across some of the retailers, particularly in the last couple of quarters. And Kaap Agri is not immune. Now, moving into the summer season, as the weather gets warmer and as the farmers start coming back and preparing for the coming season, they should start to do a lot better. They have got significant investment in place to expand their fuel network, the Agrimart retail operations, and their QSR stations. So I'm utterly unconcerned that Kaap Agri has got a very rosy future ahead of it. But as I wrote in my notes, I've been a Kaap Agri shareholder, or KAL Group. They get very cross when I use Kaap Agri. Has a very rosy future, and I certainly would not be a seller. But if I could pick up a stock a few bucks cheaper than the current price of 50 Rand, then I certainly would. When I issued my note, the stock was trading at 52 Rand. It has been as high as 53.25 in the last couple of weeks. And I think as I've cautioned my institutional clients to a potential slight weakness in the earnings, the price has started to drift back. I would be much happier picking up the stock on an off day in the mid 40s. And if I'm right again in my prognosis for a speed bump in the KAL earnings, as I am with Afrimat, I think you'll get an opportunity to buy both of those stocks, which are both excellent stocks for long-term growth portfolios in the coming weeks. I wrote an article in the recent edition of the Financial Mail Investors Monthly, where I had Afrimat, KL Group, Sabcap, Premier, and Novus as 5 stocks that I would absolutely want to own in a long-term mid-cap growth portfolio. Now, I always caveat my advice on these such webinars in terms of do your own research, speak to your portfolio managers, and get a heads up as to what's going on. Do not rely on some amorphous gentleman in a blue shirt and blue glasses chatting to you online. But having covered these stocks for many, many years and owning them in many cases personally, I have a high degree of confidence that despite any speed wobbles that certain companies may have, there's nothing fundamentally strategically wrong with any of these underlying stocks. The other company that I want to quickly run past is the private education side. As I mentioned at the start of this preamble, I'm a big fan of annual journal meetings. And I did all the educational AGMs this year in about mid-June. They all came up with extremely good updates, which was a foretaste to the interim results to June, which all came out in August, early September. They were exceptionally good. I went out in a limb at the time saying the best performance I expected was from Stadio. And I went out saying Stadio would be the stock that I would pick on June the 18th as my winner. And since that point, the stock has outperformed the entire education sector. And in terms of ranking 1, 2, 3, as I checked before I came online, Stadio's up about 26% since June the 18th, Curro up about 24 to 25%, and Advotech 13%. I'm a big fan of the private education sector, and I'd want to own at least one stock in any long-term growth portfolio. And the stock that I'd want to own is Stadio. Despite the fact that I've got Curro holdings in my top 9, and it has done extremely well year to date. It's currently up, it's up 18.1%, and it has been slightly higher. I chose the stock at the beginning of 2023 at 9 Rand, with a target price of 16 Rand. Now, it got to a recent high of 13 Rand 70, and we still have quite some time to go. And we've had 5 successive improvements in earnings. And I think all of those naysayers in the wider marketplace earlier this year that said the private education market was doomed because nobody had money and no one was prepared to send their children to private school and the fees would not be increased because parents had no money. They've all been proved wrong. The underlying growth in the organic and the earnings growth in these companies have been quite reasonable. Organic growth has been in learners in the early single digits, and earnings growth have been in the high to mid-teens. So I will take that any day of the week. So I'm still very fond of Curro, but for any long-term portfolio, Stadio would be my top pick. The stock today hit a new 52-week high. I think it closed at 6 Rand 25. Brimstone placed a 5.4% stake to another black empowerment company at 5 Rand 90. So that's fairly good news. This placement is old news to me because given I cover Brimstone and Stadio, I was well aware of the unwind of the Brimstone Black Empowerment maturity date of the structure that was put in place some years ago. And the cessation of that investment and the stock now going to a stable Black Empowerment hands with a similar lock-in means a potential overhang in Stadio of some 46 million shares has now gone away, which is why the stock ran quite nicely. So I still am very fond of the private education sector, but in 1, 2, 3, it would be Stadio, Curro, Advotech. There's nothing fundamentally wrong with Advotech. It's had a very, very good run, but I think the other stocks have just got more growth behind it in the near term. And then lastly, to finish off my top 9 is the poultry stock Astral Foods, which is up year-to-date 25.28%. It was up 30% up to a couple of days ago. The price has come off its recent best, but again, a number of metrics is playing out in its favor. The key metric that dictates the profitability of a poultry company, doesn't matter which one it is the availability of well-priced inputs, which in Astral's case would be soya and maize. We want reliable energy in terms of electricity, in terms of the power needed to rear the chickens. An interesting tidbit for you. It's amazing the things you learn as an analyst covering the poultry sector for 20 years. The second biggest cost in rearing a chicken, apart from feeding it, is energy. Now, why would that be? Because it takes energy to actually keep the chicken sheds either warm or cool. Chickens have a very low tolerance to temperature variation. If it gets too hot, they basically go mad. A temperature above 29 or 30 degrees, they basically go bafuk, excuse my language, and they stop breeding, which is not exactly good for a chicken company. If it gets too cold, they basically freeze and die. So you generally have to keep a chicken shed around in the mid-20s. And as such, energy is a very important constituent component in rearing a chicken, aside from the cost of energy, in slaughtering the chicken, in processing it, and of course in freezing it and its underlying delivery. So with the cessation of load shedding, Astral Foods back at its worst in 2023 was spending 60 million rand a month buying diesel to run its generators. That is now down to between 10 and 15 million rand. So there's been a significant saving in input costs. They also hedged their maize price quite judiciously a few months ago at around 3,900 rand a ton, which is around 300 rand a ton cheaper than the current SAFEC price. And going into the new calendar year for the harvest, the price is also looking to fall by about 300 or 400 rand a ton. So despite the fact the consumer environment is very tough, and the underlying price of chicken year-to-date is only about 10% down, and the quick service restaurant market has seen very weak pull-through, the underlying improvements in the key input costs of feed and energy into Astral Foods alongside Rainbow and others should see significant benefits coming through. And as a September year end, having had a very bumper interim results, I'm forecasting fairly succulent results to the end of September, and I'm expecting a very, very juicy trading update to come out sometime in mid to late October. I'm expecting gearing to come down quite sharply because Astral normally has a very fat cash balance, but they had to gear up last year when things basically hit the fan, and dividends should resume. But despite Astral being up roughly 25% year to date, I'm going to actually talk about one of my other stocks, which looks very interesting. So we're now at 7:10. So I'm going to spend a couple of minutes just running through some stocks that I think look very interesting, because if you haven't been in my top 9 this year, a lot of the easy money has been made. And I'm very, very reluctant to recommend anyone going into stocks that I've had on a buy list for quite some time when they've all had substantial gains. If one counter has had a very good run, it naturally assumes, unless there's something significantly wrong with a company, a similar company in a similar industry should be performing as well. So if Astral Foods is up 25% year to date, and it has been up as high as 30%, why would Rainbow be lagging? Rainbow Chickens, which was unbundled from RCL on the 28th of June at about 3.65 rand, quickly around to 4.75, but I issued a note on the 20th of June stating I wouldn't touch the stock because it looked too high. It went to 4.75, it went all the way back to 3.30 rand, and today it's trading at 3.65 rand. Now, I'm in no rush to buy the stock because it's still finding its feet, given its unbundling from RCL. And towards the end of the year into 2025, Martina Stander, the CEO, who I've known for many, many years, should hopefully give us a much more detailed presentation as to the prospects and the underlying capabilities of Rainbow. But I met with Martinez in Cape Town a week last Monday. I was one of a handful of analysts and institutions he actually met. And he indicated to me that Rainbow has actually got a very interesting mix of business. Unlike Astral Foods, where some 55% of its business comes from a low-value, very competitive, quick IQF frozen portion business. In Rainbow's case, it's less than 25%. There's a very large QSR segment, which supplies KFC, Nando's, Hungry Lion, etc., etc. They have a nice value-added business, and of course, a food service and food wholesaling side. So they have a much more balanced mix of businesses, which I think of a longer term positions the company very elegantly in the poultry sector and removes some of the volatility of just being in the commoditized end of the marketplace. So I'm not saying that anyone should rush out tomorrow and spend £3.65 buying Rainbow, but I will tell you right now, the question that my institutions ask me whenever I do presentations, and I'm on the road right now, is they always ask me, Jenny, at the start or the end of my presentation, Anthony, what are you doing? Because if I'm looking at something, I'm looking at it for a reason. And the two stocks that I'm looking at right now is looking interesting, despite the fact they are fairly contrarian, because they've both frankly been disappointing. Is Rainbow at £3.65 in the poultry sector, and Sea Harvest in the fishing side at £8.50. Now, Sea Harvest as a recommendation has been quite frankly awful for me for the last 3 years. All the promises of earnings recovery that the company has delivered to the marketplace has basically been missed. I liken Sea Harvest to like a Swiss watch. Every watch, particularly a good one, has to have all the moving parts moving elegantly to give you a good timekeeping regime. In the Sea Harvest case, something always goes wrong. If it's not poor wild fish catches, there's not enough milk, which means that Ladysmith Dairy does poorly. Well, the abalone side doesn't do well because China is in a mess. Or Australia's not doing that well because there's a glut of prawns. So there's always something on the go that basically hammers the earnings of Sea Harvest. And in the last 3 years, from a peak of about £1.58, they had earnings this year of £1. So on a price-earnings ratio right now of 8.5 times. They aren't exactly cheap, but I think in the next 12 months, there could be an element of recovery coming to the stock where earnings could get back to about £1.10. Now, £1.10 and an £8.50 share price, it starts to look fairly attractive. And interestingly, given I cover the entire fishing sector, I&J inside AVI, Oceana, and of course, Sea Harvest, all the CEOs in the last 2 weeks have indicated that the wild catch has actually started to improve as the fishing season moves from an El Nino back to a La Nina, which means the fish start coming nearer to shore because of the changing water temperatures, which means it's easier and more cost-effective to fish. So if, as I imagine, the dairy side is now basically sorted and the wild catch starts to do better, yes, there's still the issue regarding abalone and perhaps the Australian operation, which is still lackluster given the prawn glut. If I see Sea Harvest getting back towards the £8 level, which is where it was a couple of weeks ago, I would be very, very interested in potentially accumulating that stock. So I will tell you right now that the two stocks that I'm looking at in terms of the next sort of work that I do in the next few months, potentially into 2025, would be Sea Harvest and Rainbow. Not because they are currently looking attractive right now, but in the way that I work and in the mosaic theory of the tidbits of information that I put together to build a cohesive story, which I go out to my institutional clients, given the expertise and experience that I have in over 30 years of analyzing companies, is those two stocks right now that look very interesting to me. The other one that looks very interesting is Cashbuild at £1.60, it's 165 Rand. The stock has been as low as 140 and is bumping around the 155 to 165 level with an inability to break out. I actually spoke to Werner de Jager, the CEO, a couple of days ago, asking him how prospects were in the first few weeks of their new financial period. And they said, well, there have been an improvement, perhaps driven by the two-pot system, but it was far too early to say if a sustained consumer recovery trend had been seen. And I think until we get some clarity regarding the recovery in the DIY building a residential sector, I don't think the likes of an Ital Tile and a Cash Build are going to run away with itself. I'm sure many of you would have seen the PPC trading update, which came out a couple of days ago, which was quite frankly awful. I expected that, given the work that I do in cement and the construction market. So again, there are varying touch points in the overall building, DIY, residential and commercial building sector, which are still not putting the right spin on pulling the trigger to invest in the sector. So the likes, for example, of a Cash Built, an Ital Tile, and to a certain degree, a Calgro M3 and even a Baldwin on the fringes, to me, are not yet looking interesting to a point where I would pull the trigger and issue a buy recommendation. But I have been telling my clients that these are the stocks that I'm looking at. And as such, if I'm looking at them, I'm looking at them for a reason. So certainly not stocks, Sea Harvest, Rainbow, CMH, sorry, Cash Built, Ital Tile, etc., not ones to rush out and buy, but certainly ones to put on your watch list to keep an eye on the trends. And at some point in the next couple of months, they will start to look very interesting. Other stocks that look very interesting in my life right now are the QSR stocks. I've had a long Spur Corporation, short Famous Brands straddle for 2 years, and it's done me fantastically well. Famous Brands has underperformed by some 50%. But interestingly, in the last 2 weeks, Famous Brands has gone from a relative 5% down to a relative 10% up. And Spur Corporation has risen 12%. So the entire QSR sector, to me, again, counterintuitive, because there's nothing fundamentally driving the sector. I've had conversations with management, and there's still no discernible consumer trend. The market clearly believes that with the interest rates falling, a two-pot system, and perhaps some form of very light growth coming into the economy in 2025, there's an element of perhaps institutional investors buying the sector ahead of sustained recovery. But everything hinges on the December trading period. Having covered these sectors for over 20 years, I know that December, of a key festive trading period, is very key regarding the school holidays and the predisposition for consumers to spend in that period. So whilst Spur and Famous Brands, to me, look very interesting, I would be probably nibbling on the sidelines. I certainly wouldn't be going in and putting a percentage of my funds into those stocks, but I certainly would be nibbling on the sidelines. And Famous Brands at 63 Rand 54, it was 52 Rand when I started my work on the stock. And Spur Corporation currently 35 Rand 97. It was 32 Rand when I started my work. Have ticked up quite nicely in my deliberations and initial work on those stocks. So I'm going to stop there at 20 past 7 and just reiterate once again that the top stocks have done quite well. A lot of the easy money has been made. I'd be happy to own them all, but I'd be very cautious in the next few months on Afrimat, KAL Group and Libstar, and also on Novus. Not that any of the companies have got anything fundamentally wrong with them, it's just that there are varying touch points given the run in the share price and perhaps earnings speed wobbles in the case of Afrimat, Libstar and KL Group, which urge some caution. And that's what I've been telling my institutions in the last few weeks. And looking at the Q&A session, give me a second. I'll flick through, and if there's anything that I can talk to you on, I will. First question, RCL and Premier. I've discussed Premier at length in this presentation. RCL, I actually don't like a great deal. If any of you are readers of the Financial Mail, I urge you to buy the current edition on the newsstand. I wrote a 2-page special feature in the Investors Monthly talking about all the food producer stocks in the J357. And RCL was one of them. And if you've owned RCL, the stock has gone absolutely nowhere in over 20 years. And I have no reason to believe that that's changing anytime soon. So given that the question is, what's your view on RCL and Premier? If I had to own any one of the two, it would be Premier. I wouldn't touch RCL, and its time will come, but God knows when. Question on Impala Platinum and Signia Holdings. I do not cover Platinum, so I'm not going to go into PGMs. I'm certainly not that clever. On Signia, I put a comment on my Twitter page, which is at Small Talk Daily for those that don't follow me, about a week and a half ago. And anybody that knows the way that I like to work is I often put tidbits on my social media page just to try and whet the market's appetite. Because as an analyst covering the sector, and very few analysts actually cover Signia, this is a company which has underperformed Coronation over the last few months and basically tracked sideways, whereas Coronation has moved up quite nicely, one because of the cessation of the SARS investigation, the fact that it's paid a special dividend, and in the last few months we've seen significant uplift in market activity, which means the large asset managers will start showing very good performances, and as such, fee generation and performance fees on the assets under management. So Coronation has picked up quite nicely, but Signia has been left behind. So I put a little comment. Oh, the dog wants to go down. Oh, down you go. That's the dog wants to go down. I put a comment about a week and a half ago at about 20 Rand, and about 20 Rand 30 cents. But Signia, to me, I believed, as a September year end, with results coming out probably in late November, early December, would show a reasonable growth in earnings year on year. We all know they pay fat dividends because the owner, CEO, Magda Vierjiska, likes to pay out pretty much all her earnings in terms of dividends. And the fact that I believed that there might be a significant uplift in the underlying growth in assets under management coming. So I laid that dangler there. So as a gentleman who's covered Signia since the listing, I thought at 20 Rand 30 cents, the stock had a very interesting dynamic, given it had lagged the asset management sector. And I expected some fairly positive touch points, some fairly good touch points to come out in the forthcoming results period. And I had a price target on the stock of between 23 and 24 Rand. Now, that might not sound like a huge uplift, maybe like 10 to 15%. But if you also factor in the fat dividend, you might, in theory, get between 20 and 25% in the next 3 or 4 months from Signia. So I still believe the stock looks fairly interesting. But once again, do your own research. I'm certainly not sure to be the oracle of Devarikant. Scrolling down again, so let me have a little look. Good question here. Do you think Frontier's capex and electric buses will impact their short-term profitability and dividends? That is an extremely good question. I wrote a note on Frontier about a month ago. It's a stock that I've followed for many, many years as part of the HCI stable. And you are correct. I do not believe, as I've written, that there'll be any further special dividends coming for at least 2 years, because the money that they have to spend on electric buses is quite material. And what they've done with BYD, the Chinese company, is they've done a special deal where they will buy a large upfront order of electric buses, which should suck up about R1 billion in cash for the importation of the buses, the fabrication, the underlying electricity reticulation, etc., etc. And that capex will come at a cost, and the cost will be higher interest payments and, of course, the inability to fund special dividends. Not that this is a bad thing. The cost of an electric bus in terms of its running is about 60% cheaper than a diesel bus. So there will be a transitionary phase, but as Frontier Transport starts moving more of its fleet over a number of years towards a greater proportion of electric buses, the underlying operating costs will start to fall quite marketably. So at about 7 Rand 50, I have advocated that Frontier stock is a classic widows and orphans company, where they've had very stable earnings growth from their passenger numbers and their price increases, and the fact that this management team are very good capital allocators coming from the HCI stable, and the move towards electrification of their buses starts to rapidly reduce their costs. So all in all, yes, will be a short-term impact to their dividend payment, but in terms of profitability, I think it should start to tick up as these lower costs come through. Let's not forget, but like on like, from September 2023 to September 2024, the diesel price is down 26%. That will have a significant impact to Frontier's earnings going forward. And I think we have another rand a litre coming today, if I'm not mistaken. So Frontier, I'm very happy to own, but it's had a hell of a run. I recommended that stock last year at £4.25. It got to 7.50, and you've had fat dividends from the company as well. So anyone owning that stock, despite its illiquidity, has seen a very healthy capital appreciation and, of course, a nice dividend. Let me scroll down. Big question on Argent. I think I've answered most of that. Question: do I accept retail clients? I'm asked that often, be it personally or on my social media page, and the answer is sadly no. For the last, my God, since I entered the market when I was 26, which is a long time ago. So I'm currently 57. I've only ever been an institutional analyst, and I have an agreement with Rand Swiss where they participate in these webinars, and I make my research available to a selection of their clients. So in the case of private clients, I do not distribute my research to private clients. It only goes to the institutional market, where I have a very wide institutional client base, and then I have the dedicated agreements with select private client bodies like Rand Swiss, which get my content. I'm looking at the time. I will take one last question, and then I'm probably going to have to go. Let me have a quick look here as I scroll through. Another question on Premier. It's basically saying, the question asks, won't it take a long time for Brait to sell their remaining stake in Premier? Now, interestingly, I know the company extremely well. And as I indicated earlier in my preamble, Brait recently sold another 1.69% stake in Premier on the back of the inclusion in the Aussie 100, where there was significant demand for the company. And on that day, before the index changed, over 20 times average daily volume went through the market, which I assume was part of a Brait stake. We also had a placement by Brait earlier this year at 60 Rand, where some 900 million Rand of stock was quickly snapped up by the institutional market, and a green shoe was put in place because demand exceeded supply. Now, interestingly, the single largest shareholder in Premier is Christo Visa, and he also is the single largest shareholder in Brait. And it is made clear to institutional shareholders that Christo Visa is not predisposed to allow Brait to keep on dribbling stock into the marketplace. And it is likely going forward, and I can quote, there will either be an unbundling of the Premier stock from Brait into the wider market, and or Brait would entertain institutions or interested parties making an offer to buy the entire block from it. So if any institution who would like to get hold of Premier, and its market cap is currently, call it 13 billion Rand, which is still quite small in the scale of things, and there is very tight liquidity. I think if it were to suddenly place the stock in the marketplace by an accelerated book build, I would imagine that institutions would easily take that stake from Brait should it be sold in due course. Now, granted, if it were to be sold, it would have not an overhang, but the market would be filled in the near term. There's an old market saying, when the ducks are quacking, throw them some bread. So I think the stock would be mopped up, but once the stock has been mopped up, then the natural buying of Premier would probably be fairly flat for quite some months as the stock was digested, and then it would pick up as the underlying earnings and results cycle came into place. So I have no qualms that if Brait were to dispose of any more of its Premier stake, I think there is sufficient interest in the institutional market for this company, giving us liquidity to see institutions both locally and internationally want to own the stock. It's now moving into a realm where international investors would want to start participating in owning Premier. So in that case, I have no interest. Sorry, no qualms in letting Brait sell some more shares. Looking at the clock, I've gone over time, and I know that Pascal has to get home to look after her family and cook supper. So from myself here in Cape Town, I want to thank you once again for participating in this Rand Swiss Small Talk Daily webinar. I hope it was instructive. My voice has held up. Hopefully you've gained a certain degree of information in the narrative that I've given you. As always, I always give a caveat in terms of do your own research, speak to your private client relationship manager, and looking forward to seeing you again in the next quarter. I'm sure we'll do one probably around the Christmas period. And I'll hopefully see how the stocks that I've recommended in the top 9 are fared in the last quarter of the year, and how some of the other stocks that I've given you to keep an eye on, like Rainbow, Sea Harvest, Cash Built, etc., perform in the coming months. From me and the dog, who's now snoring on the floor, I wish you a safe and happy evening, and I will chat to you very soon. Thanks again, Pascal. Thanks to Gary and Rand Swiss, and I wish you a very wonderful, kind evening. Take care.